Welcome, everyone. Another very timely topic for you all with growing demand for climate-related disclosures by investors, regulators, and other stakeholders, and a subsequent need for consistency and standardization. In March, the SEC released an exposure draft that would make mandatory certain disclosures about a company's climate-related risks and its response to those risks. We're going to start our discussion with an international perspective covering the developments outside the U.S., and then we're going to turn our discussion to the U.S. with an overview, including current climate reporting landscape, the intersection with financial accounting standards, and key aspects of the SEC's proposed rule. We're going to cover challenges public companies and auditors may face in light of this proposed SEC Reg X and Reg SK requirements. And then we're going to end our time with how public companies and auditors can prepare for the upcoming SEC final rule on climate change disclosures. As usual, we're going to leave plenty of time at the end for questions, so please feel free to add questions while we go. These could be submitted through the Q&A button on the bottom of your Zoom screen, and we're going to make sure we cover those at the end. So let's get started by introducing our wonderful set of panelists today. I know you're going to enjoy this immensely. As a lead advisor with RSM's ESG advisory practice, Anthony DeCandido guides companies and boards of directors through ESG strategy development, data collection, and reporting and communications. Julie Santoro is a partner at KPMG, where she leads ESG activities for the Department of Professional Practice, and is also part of her firm's KPMG Impact Network. And lastly, Mark Shannon is a partner in Crowe's LLP's national office, focused on SEC rules and regulations as well as ESG topics. Welcome to our panelists, and let's get started. Maybe I'll just kick off with you, Julie. While today's discussion will be US-centric, before we dive into that discussion, it may be interesting for us all to get a broader perspective. Can you share what you're seeing in the international space?
Yeah, Lara, thanks for that question. I always think when we start discussing what's happening in the US is to really draw back and have a look and get some perspective about what's going on elsewhere. Because as you'll see when we go through it, the SEC is actually looking at one small part of sustainability or ESG reporting. So if we first compare that to what's happening at the International Sustainability Standards Board, they're still looking at kind of an investor focus, but they're looking broader. So they've got two exposure drafts out there. The comment period just closed. They've got one looking at climate, so that's similar to what's happening in the US, but they have another general proposal as well, which is much, much broader in terms of its implications. So already that is broader than what we're looking at here in the proposals. And then if we have a look at what's happening in the EU, they have, and the comment period just closed, it closes today actually. They have a whole suite of exposure drafts that they issued, doing an incredibly deep dive across a whole host of sustainability topics, goes much, much further than even what is happening internationally. And the big difference is that in Europe, they are looking at kind of multi-stakeholder materiality. So looking not just at investors, but having a look at customers, local communities, employees, like all of the stakeholders. So really, I think we have to keep in perspective that in the whole kind of world of sustainability reporting, we're actually looking at quite a small slice of it here in the US.
That's incredibly helpful. But for the moment, I'll bring it back to the US, but just to give us a sense of where we nest globally, I think is really important. Maybe I'll start with this next question, which is the current climate reporting and disclosure for landscape. What is it? And maybe I'll start with you, Mark.
No, thanks. I think, Julie, I loved how you put that, because I think climate, it's important to remember that we're talking about climate today and not the broader ESG landscape. I think if you look at the broad reporting context, there's a lot of things going on in the world of ESG because of stakeholder interest. And of course, climate is one of those things that really has a lot of stakeholder interest in it, both from a disclosure perspective as well as from a policy perspective. But we're going to focus on disclosures today. So as you think about the disclosure landscape, I'm going to focus my comments on the S&P 500, but I want to start with White & Case's 4th annual ESG study. So they just released this last month. And when you think about trends in climate disclosures, one of the things that they noted in their study of the Fortune 100 is that climate-related disclosures significantly increased in Form 10K and proxy statement filings, so SEC filings of the Fortune 100, with many companies including that disclosure for the first time in 2022. So the staff of the CAQ helped me out a little bit. They gave me some research that they had done, and this is all very preliminary research, but they took a look at the S&P 500. They looked at all of the most recent 10Ks of those companies to really understand what is being disclosed around climate. So let me give you a few data points to just give you that broad perspective. The substantial majority of S&P 500 companies mention climate change somewhere in their 10K. So when I say somewhere, you might think, well, what's that location? What is the disclosure location profile of that climate mention? So of those companies that mention climate, 96% of those companies mention it in risk factors, 49% mention it in their business description, and then it falls off pretty quickly from there. So less than 20% mention it in MD&A or management's discussion and analysis, and then even fewer, less than 5% mention it in their audited financial statements. From a content perspective, so that's the location, what does that content look like? The majority of S&P 500 companies mention climate but don't provide quantitative data. So when I talk about quantitative data, think things like net zero goals or greenhouse gas emissions disclosure, things like that. About 20% give some of that quantitative information. It's not the full gamut that we'll talk about today, at least with respect to what's being proposed from the SEC's perspective, but about 20% give some quantitative information. And then you might ask a question about commitments. So how many people are making that net zero or carbon neutrality commitment? Vast majority of companies that the CAQ looked at don't have a mention of that net zero or carbon neutral commitment in their 10K. But of those that do mention it, so around 20% of the S&P 500, many have a date that range from today out into the future, but the most common date mentioned was the year 2050. And then last but not least, in terms of how are people crafting these disclosures, the majority are using the Task Force on Climate-Related Financial Disclosures framework or standards, as well as the Sustainability Accounting Standards Board, and then a minority are using the Global Reporting Initiative. So that really gives you that broad perspective.
That's great. Thank you so much. Maybe just to give us a full spectrum, maybe Anthony, could you share with us how that contrasts or maybe doesn't contrast or probably does contrast with smaller mid-cap companies?
Yeah, sure thing. Well, thanks, Lara, for the introduction, and it's good to be with you all here today. I think it's important just to set the stage to identify a little bit different around the client portfolio that we serve here at RSM. So as you said earlier, RSM prioritizes middle market businesses, and these are companies that represent around 40% of overall US GDP and roughly 1/3 of the US workforce. So they're generally $1 billion revenue companies or less, but we oftentimes work with companies that are larger or smaller. And here's the deal with mid caps. There's a major misconception today amongst non-public companies that they are exempt from climate reporting. And the reality is that a lot of these mid caps are part of the value stream of some of their larger public company peers. So in many examples, our role as their advisor is to make sure that they're contemplating the full spectrum of the value chain for which they align to. So it's not necessarily that they're required to disclose, but they're enabling other companies to disclose better. And what we're also noticing amongst our clientele is there's many degrees of preparedness, starting from one extreme, which is those that are already educating themselves with the expectation that this will be enacted, and they prefer to be ahead of the game, versus those who are choosing to be smart followers And also lastly, those who don't want to lift the pen yet until it's absolutely required. And, a lot of people spend time talking about, these level of dimensions of preparedness, but the reality is this behavior is something that we've observed historically in the accounting profession already, whether it be with 606 adoption, revenue recognition several years back, as well as 842, which was the leasing standard that just came enacted just recently. In mid-market, there's also a major skills gap. Even our most sophisticated clients today with rich business acumen know little about climate reporting. But as of late, we have seen a change in the discussion around the mid-caps from what it is to how it will actually be enacted, as well as some of the mechanics that surround that level of exercise for GHG inventory, which we'll speak more about later on. So unless you had someone on staff with a climate sciences background or someone who was self-trained with some of these GHG principles, they might struggle with some of the topics of climate-related disclosure. So I wanted to spend just some time on the upfront of the call on what I see as to be the 3 or 4 top issues that our mid-cap clients are struggling with, starting with just the disclosure itself. The guidance for TCFD breaks down both physical and transition risks. I think the physical side of the house is much easier for nearly all of our clients to understand because it's qualified events like severe flood or storm or wildfire, and those are pretty easy to identify. But what's more challenging, because it creates a lot of qualitative considerations, are things like policy and legal risk, could be technology risk, market risk, or even reputational risk. So I'll just spend a little bit of time talking about each one of those for a second. On the policy side, just imagine now if you're a globally active business. We're here talking about SEC's proposed guidance on TCFD, but there's many local jurisdiction requirements from a regulatory perspective abroad, as well as on a sector and or industry basis that a globally active client would have to consider. On the technology side, think of an industry like the automotive space. This is ripened for disruption in that there's all kinds of renewable energy sources that will affect the competitiveness of that sector. So being able to forecast what that means on a company by company basis is quite the challenge, along with how that'll impact market, just around basic things like the supply and demand for those products and or services. And then lastly, around reputation. So it could be something just as simple as human rights or labor practice violations. We think about governance. Governance is an area that our most seasoned and executive level clients even are challenged by, because it's almost as if you have to recraft a lot of the policies and practices to address the approach to climate related risk. And that's the bad news, because again, a lot of these groups lack that level of technical acumen. But the good news is that these groups have been through something like this in the past. So you might have a counsel on in-house, or you might seek outside help in that way, and most likely will bring you past that challenge. Now, on the strategy side, because that's also one of the headline components of the guidance, you get topics like how an identified climate-related risk will have affected or likely to affect that registrant strategy, as well as their business model and outlook. And this is where it gets really hard, because again, there's a high level of degree of judgment and uncertainty within those forecasts. And then last but not least is the famous portion of the guidance, which many people think the regulators and the accountants are in cahoots, so they design this for the benefit of the accounting profession, which is not the case, because there's issues around attestation. And as this information gets far more relevant and useful in market, we understand that to instill a level of public trust, that you would have to have independent verification as we know it in the way of attestation. And mid-caps are preparing for this a little bit differently than some of their large cap competitors in 2 ways. One, in a basic public company audit requirement, you're going to have to upskill the professionals, and they're going to incorporate this into their audit plan, no different than some of those other watershed moments with RevRec and leasing. But what a lot of people don't spend time thinking about is in scenarios where you have these standalone ESG, corporate social responsibility, or even impact reports, what level of assurance might afford reliability on those. And that's an issue, knowing that many of the major market makers, these are the insurers, the banks, the asset managers, are increasingly using these disclosures in the way of determining an output score. And those output scores, as some of you know, are relevant to the extent of how insurers are underwriting risk, as well as how those banks are providing financing and how those asset managers are determining market pricing. So there's a whole list of challenges that come with both of those levels of attestation. One way or the other, we're going to get there. The question to me is more so, what time scale will that happen?
That's really helpful. Now we have, I think, a good foundation for the market as we segment it. You touched a little bit, Anthony, on some of the requirements, but let's get into those just to make sure we cover them soup to nuts. So maybe, Julie, for you, what are the current reporting requirements on climate-related disclosures?
Yeah, because I think actually right now we're all swept away with the SEC's proposal. So we can't forget that there is actually guidance already out there. So the SEC staff issued their guidance in 2010 on climate-related disclosures outside of the financial statements in filings and their kind of expectations. And then last September, we saw that they issued a sample comment letter saying that they were starting to ask questions based on that guidance about like kind of a list of areas they were asking about. While we've all been kind of looking at the proposal and commenting on the proposal, they have continued sending those comment letters to registrants. So as of now, we have like over 30 issuers have had the letter. Like we're looking at some 180 comments, really asking about. All of them were asked about physical risk, but also transition risk, your business strategy, the impacts, etc. Very importantly, over half of the companies were asked about kind of a potential discrepancy, or whatever you want to call it, between what they were saying in kind of sustainability reporting and what actually made it into the filing. Kind of asking questions about how that tied up. So it's really important that we don't lose sight of that. And then I guess just to do a quick plug on the financial statement side, of course, the potential impacts on the financial statements, regardless of any kind of final rules from the SEC, continue to grow. So we have a FASB staff educational paper going through some of the basics of what could be affected, kind of impairments, property, plant and equipment, useful lives, etc. But what we're also seeing is a rise in contract modifications relating to kind of climate triggers, compensation linked to ESG. And then, of course, we're seeing a rise in kind of things like sustainability-linked bonds that have embedded derivatives in them. We're seeing carbon offsets and those transactions increasing. So watching the FASB's agenda there. So all of this is going on in the background while we're kind of watching the proposal and what happens to it.
That's really helpful, Julie. And so let's get into the overview of where this is going. We're going to spend a good amount of time today talking about the challenges that some of the auditors and issuers may face in light of this proposed rule. But before we get into that, and again, I think, Mark, you started to tee this up, give us an overview of the key aspects of the SK and SX requirements, please.
Yeah, Lara, you mentioned challenges. So my challenge is to take a 500-page document that lays out the proposed rule and get it into 3 to 5 minutes of just talking about it. So I'm gonna take on that challenge, and we're gonna get it done. So if you think about the SEC's proposal, I like to break it up into 2 different parts. You've got financial statement disclosures. So those are the ones that are regulated under Regulation SX. And then you have disclosures that are outside the financial statements, and those are the proposed Regulation SK requirements. I'm going to start with those, the outside the financial statement disclosures. Early on, I mentioned that the S&P 500 had some mention of TCFD, or Task Force for Climate-Related Financial Disclosures, as the basis for the disclosures. Anthony, you mentioned TCFD as well. And so to just give you a flavor of where are these disclosures coming from, they're all based on TCFD. Now, they're not directly linked to TCFD, but they've got the flavor of TCFD. So let me start at the top, governance. Your going to have some disclosure requirements around governance. How does the board oversee climate-related risk and opportunities? That's always an important add on the back end, is the opportunities. Who's responsible on the board for climate-related risk or opportunities? Do you have a climate expert? How does the board educate themselves, and how often does that happen? And how does the board consider climate risk as part of business strategy and opportunities as well? That's pretty important when you think about strategies. And also disclosures around how does the board risk manage? How do they produce their financial oversight over these types of topics? And then does the board set climate-related targets or goals? There's some disclosures for management and how they govern as well. Very similar disclosures: who's responsible, how are they assessing it, how do they inform the board and interact with the board on these topics. From a strategy perspective, Anthony, you laid this out well. There's a whole section of disclosures around the business strategy, the business model, and the outlook, and how are those things being impacted by climate-related risks and opportunities. Anthony, you mentioned physical and transition risks. So the climate-related risks and opportunities will be disaggregated into physical and transition risks. There'll be further disaggregation into acute and chronic risks. There's a very detailed disclosure, proposed disclosure around locations of assets. And then the risks and opportunities and how they impact the registrant's business, their strategies, their models, and their outlook. That's going to be a very qualitative disclosure at the outset of the document, outside the financial statements. There'll be risk management disclosures. So once you've identified all those risks, how are you managing those risks? How are you assessing those risks for materiality and significance in terms of how do you want to address those risks? If you have transition plans, that will be a required disclosure. If you have targets or goals, that will be a required disclosure. And then last but not least, at least in terms of outside the financial statements, are greenhouse gas emissions metrics for all of the historical periods presented in a filing. Scope 1 and Scope 2 greenhouse gas emissions required for all registrants. If material, and I want to highlight that part, if material, because that we'll talk about challenges later, but if material, or if a registrant has included Scope 3 emissions in any targets or goals, then those registrants will be required to disclose Scope 3 emissions, except smaller reporting companies, which are exempt. There's a number of other detailed and disaggregated quantitative disclosure requirements, as well as disclosures about methodologies and assumptions for greenhouse gas emissions. And then we mentioned attestation. Attestation or assurance on Scope 1 and Scope 2 emissions are required for large accelerated and accelerated filers on a phased-in basis, beginning a couple of years after a first compliance date, and there'll be limited assurance, and then there'll be reasonable assurance. And we'll talk a little bit more about what that means as we go through. That's the outside the financial statement disclosures. The inside the financial statement disclosures under Regulation SX, those are all subject to a disclosure threshold. And this is the important part of Regulation SX. There's a 1% disclosure threshold for individual line items in the financial statements, using the absolute value of all the impacts on the line item, be them positive or negative. So there's a lot of data tracking that has to happen, as well as 1% threshold for expenditures and capitalized costs. So to the extent those impacts, so financial impacts of severe weather events, impacts of climate-related risks and opportunities, financial impacts of transition activities, to the extent they exceed that 1% threshold, required disclosure. Also, you'll be tracking expenditures to mitigate risks, as well as impacts to financial estimates of all of these items. Anything over 1% triggers the disclosure requirement. So that's really a fairly significant challenge, I think, and we'll talk about that as we go through.
Well, you did what you set out to do as your biggest challenge. I think you've given as comprehensive an overview as you can. And I think the best use of time is to really double click into some of the challenges to bring it to life for our viewers. So we'll start with SX and those requirements. And Anthony, I'll start with you. What are the potential challenges for companies and issuers associated with these SX requirements?
Yeah, sure thing. So I think just to lay this topic down, I'll just share a little bit of some of the roles I've played outside of the firm to give context to what I'm about to share with you. So yeah, I've been one of the lead sponsors at RSM of helping in the preparation of our comment letter, as well as a participant member of both the AICPA and even AIMA's comment letter. AIMA, for those of you that are familiar, is the Alternative Investment Management Association, which is an industry that I've been aligned to my whole career. So across those three of them, which I'm most familiar with, I'm finding that the issues around consistency, comparability, and reliability are at the forefront of most organizations' comment period response. There was even a reference in one about some of the implementation requirements akin to what we've experienced in the industry with SOX, Sarbanes-Oxley. There was mention of how tremendous of an effort this would require of the practitioners and our clients alike, just educating them and so on and so forth. Plenty of discussion amongst all the comment letters around suggesting a universally accepted framework. So my colleagues in the panel have mentioned a few of them. I, like Mark, also read a 500-page document, and it's very TCFD heavy. I hadn't realized how TCFD heavy it would have been prior to reading through that guidance, knowing that there's other climate-related frameworks that are out there. So things like providing more required disclosure template examples, I think will be important. So it was Julie earlier that referenced the educational paper that came out in FASB a few years ago. When you start to showcase the intersections between traditional ESG or sustainability topics with traditional accounting principles, be it going concern or risk and uncertainty, valuation or impairment, I think that's when the discussion becomes much more real for the clients that will have to disclose. There was also mention in a few of the letters around the need for prospective versus retroactive adoption. So right now, I think there's an assumption that there would have to be some level of retroactive presentation, which a lot of the agencies and large firms are calling for the opposite, more of a prospective. And I think the undertone there is just recognizing how flawed some of the data is historically to enable decent reporting that way. I like this section around RSM's own comment period on the estimation of certainty of certain net zero commitments. So my colleagues in the panel spoke about that earlier also. And the joke was this, is a lot of the clients that we work with, even the best, struggle with making 5-year forecasts on revenue, let alone making a 2050 net zero GHG emissions commitment. So questions were around what level of requirement might the market hold a company towards in making their best estimate of a 2050 net zero commitment when we're so many years out from that. Like Mark mentioned, a lot of discussion around the location of where the disclosures belong. So whether that be in the heart of footnote disclosures or supplemental, Mark shared with you as it stands today, there was discussion about maybe putting some of that stuff in the back of the notes or even by way of a supplemental schedule. So we'll see where that all comes. Probably everyone's favorite topic is the scope 3 emissions. So, for those that feel the market is still not yet ready to evaluate the upstream and downstream GHG emissions of a public company reporting entity, some have suggested to remove that. I personally could see that happening. I don't know that that's for the better of what we're trying to do in terms of climate crisis and GHG goals and commitments, but nonetheless something that's being considered. As well as, what questions could a reputable practitioner actually assure on? So in other words, if there is disclosures that are in there, do those practitioners today possess the requisite skills to provide some level of market assurance? And on that point, we're here talking about reasonable assurance, but there is even some discussion around limited versus reasonable assurance. So for those that are less familiar, limited assurance would be things like reviews, which are analytical procedures and inquiries, or things like direct or indirect examinations, which again are substantially less in scope than the use of the term audit. So we as practitioners, we hear the market reference audit all the time, and that's relevant as it relates to the public company requirements, but is not relevant today in market as it relates to the limited assurance reviews that are going on for basic, CSR, sustainability, or impact reports. Another topic that I have a lot of passion for is just the competency of, the audit profession in the way of climate-related disclosure. The sad truth is, people don't graduate from school and say, we only want to be, a climate scientist, auditor. Instead, it's, the marrying of disparate skill sets that'll enable a good outside independent review from an audit professional. So there's a lot of discussion about the market readiness for this practitioner group to be able to opine in the way it has traditionally with financial reporting. I personally think that's a lot of noise, because if you think of basic financial reporting today, there's so many components of accounting that already are outside of the expertise of a traditional accountant that there's procedures that can be performed to enable some form of reasonable assurance. So think of like pension obligation estimates. Auditors are not trained actuaries. They just perform use of specialist procedures, and we have separate divisions in all of our large firms to assist in any of those areas that we have blind spots. So I think, to Lara's points on the onset of this session today with CAQ, it's more likely that the profession is going to upskill itself. It's more likely the profession is going to leverage subject matter expertise to the extent there's any of those gaps in a basic audit skill set.
Great. You've definitely given us a wide array of things to think about. Maybe I'll just put a pin in something, and I'll start with you, Mark. You alluded to this earlier when you were talking about the line items and absolute value. Talk a bit about the challenges companies may face regarding this percentage threshold, in particular, this 1% threshold that you alluded to earlier.
Yeah, so maybe a bit of perspective about the financial reporting environment as a whole. I think it's interesting if you read some of the comment letters that the SEC received. Preparers did highlight that 1% threshold as a significant challenge, but even users, including a large asset manager and a large investment company, said, you know what, that footnote disclosure threshold at 1%, it might be better if you based it on well-established materiality threshold. So just an interesting perspective from users. But preparers definitely highlighted the challenges of that 1% threshold. As you mentioned, it's an absolute value calculation. It's a individual impact type calculation. And so what does that tell you? Well, there's mechanical questions there, and there's a philosophical question there. So what do I mean by mechanical? Mechanical is all about tracking data. How do I track data at that 1% threshold, particularly given that absolute value aspect, as well as it's based on individual financial statement line items. So I have to take each individual financial statement line item, calculate 1%, and then go figure out which impacts and items do I have to go disclose because they reach that 1% threshold. And when you think about how do I track that, that's all about ICFR, so internal controls over financial reporting. 1% of an individual financial statement line item, for one, fluctuates over time. It fluctuates during the year. You don't know what 1% is exactly going to be until you get to the end of the year. And that level of precision, that 1%, is just different from the controls over other accounts and disclosures in the financial statement. So I think the key takeaway is that management teams have never had to really evaluate events or conditions from this perspective of climate-related risks and opportunities. And so finding those individuals that can make those judgments and then designing and operating effective ICFR over disclosures at that 1% threshold is a particular challenge. Anthony, you mentioned the transition question about is it prospective or retrospective? Well, think about not having ICFR in those retrospective periods that captured that data. I'm not even certain how you go about doing that exactly, other than it will be very hard and very challenging. And then the philosophical aspect that I mentioned, I would say, when you think about that 1% threshold, you have to ask yourself, as a member of the financial reporting ecosystem, does that place disproportionate prominence on those climate-related financial metrics relative to other, I'll call them perhaps more significant matters presented in the financial statements? So are you taking focus away from things that are material when you're putting in that information at the 1% level. Certainly a balancing act. You got to be transparent to your users, but at the same time, you want to make sure you're getting them the information that they need to make those investment decisions.
Oh, that's great, Mark. Let's pivot now from the issuer to the auditor, and then I'm going to ask you both to answer a question that came in, maybe from both angles. One of the questions that came in is around what are the benefits and costs that you could anticipate if these disclosures were made in the footnotes rather than in risks and uncertainties. So maybe, Julie, for you, could you start with what are the audit implications of what Mark just took us through around the 1% threshold? And then maybe I'll ask both of you to sort of give me your thoughts on, depending on where this ends up in the filing, are there, I'll just say, some high-level thoughts around cost benefits. But let's start with the audit implications.
Yeah, so if we take everything that Mark was just talking about from a preparer's point of view, and that incredible level of granularity that would be required at the 1% threshold, and you can just flip that over to the auditor and think about, well, it's in the financial statement, so it will be subject to audit. How are we actually going to audit that? Right now, all of our audit guidance is really premised on materiality to the financial statements as a whole. It isn't really geared for this kind of level of prescriptive granular disclosure. I mean, there is some guidance from the PCAOB, a practice audit alert that kind of talks about how you might focus on like lower level items, but in general, it's the financial statements as a whole. It's interesting for me as well that the SEC does have other granular disclosures in the financial statements, but really nothing that comes remotely close to being this pervasive, like throughout the statements as a whole. So if you just kind of step back and think about it, what that means from an audit point of view is if the auditor does an increased scope of work to come anywhere close to this level of granularity, well, you can just imagine what that would do to the cost of the audit. You can imagine what that would do to like potential inefficiencies that would arise. I also like Mark's point about potentially distracting from other kind of significant issues. And also coming back, I was also struck by some of the comment letters from users who said, hey, we're not even necessarily looking for this kind of disclosure. So for me, that really calls into question the cost benefit of kind of the 1%. Like, I think that if this goes ahead, in reality, there will have to be discussions with the PCAOB in terms of how is this made workable and how actually is this going to be audited.
Mark, anything else on cost benefits from an issuer side? Julie, you definitely touched on some of it, depending on financial statements versus, in risks and uncertainties as part of broader MD&A.
Yeah, like any great accounting question, I think the answer is it depends. And so the cost benefit, I think, is important to think about from the perspective of the user. So some of Julie's comments around, we weren't even expecting this level of detail in our disclosures is an important sort of data point to think about. But I think overall, the most important point that I would think about would be, how are users going to use the information? Like, that's the point that I want to like soak up as much information as I can. How are you going to use this information? Because that really frames what should the disclosure requirement look like, and what are the cost benefits of that disclosure? I think that how are you going to use it answers all of those questions. And so that's why I would default to, well, it depends. How are you going to use it? And then I can tell you whether or not the cost benefit is there.
Yeah. I'm gonna get you a Zoom background that says it depends. I love that as an approach. I see we have a CPE question up. I'm gonna, maybe just in the interest of getting us on to SK, I'm gonna do a little rapid fire here. Pretty brief, but maybe Julie, Mark, Anthony, I'll start with you, Julie. What are the unintended consequences that may come out of these requirements? And you guys alluded to some in your commentary, but let's hit it hard here briefly.
The one I like to hit on is potential greenwashing. We all know there's a lot of scrutiny, a lot of criticism. If you have a disclosure requirement that basically has a very broad brush on what is climate related, you may well end up with potential greenwashing.
Okay, Mark?
Yeah, I like to think about disincentivization of disaggregation. So if you think about the face of the financial statements, if I'm calculating 1% of every single line item on there, that really disincentivizes additional disaggregation. I think users want disaggregation, but when you place that context over the top, it tells me that I should be doing less disaggregation, so I don't have to have a 1% calculation on more line items in my financial statements. So I think that would certainly be unintended.
That's great. And Anthony, anything else at a high level you want to share?
I'll take a slightly different spin on what you're saying, because when you mentioned unintended costs, I'll turn that to be a literally like the financial cost of all this, because we get that question a lot. And I think a lot of it, to Mark's point, we'll laugh together now. It depends. Like, it depends upon who's initially going to cover this exercise. So we work with a lot of internal audit groups. We see people from the back office, finance or accounting group try to support this initiative. Others say, the hell with this, we're just going to seek outside help. So however you do it is okay, but each of those carries different costs. So obviously, one extreme being outside help is going to be most costly. If you reskill people within inside the organization, that has a lesser cost. A lot of people that we work with ask us questions around the kinds of things that they can do to retool their people. Believe it or not, there's an incredible offering online with TCFD, which is free curriculum that one of your best and brightest people in your organizations could complete relatively quickly. Now, on the reporting side of the house, I see this again in reference I made earlier with 606 and 842. Just the same, you're going to have initial cost of implementation, which is we've seen everything from Wall Street Journal headlines to say this is hundreds of thousands of dollars, which I think is a gross overestimate. It's probably going to be something around there or less, but maybe even a multi-period time scale. And we know that happens because sadly, ESG gets politicized as a ESG weapon because of how different people see the world. So there's absolutely some initial cost, but then on the back end, there's annuity differences, which is just added scope that would factor into your auditing and accounting budgets.
Okay, great. That's really helpful. Let's pivot, because I want to make sure we spend a bit of time here. And Julie, we'll start with you. So far, we've had this really good discussion on financial statements, and Mark gave this high-level overview around the SK requirements. So please, he gave an overview of SX and SK. What impact will those requirements have on companies relative to being outside of the financial statements?
Yeah, I think the first point I think is really important is the fact that from a preparer's point of view, it's outside the financial statements. It's still going to be filed, so it's subject to your disclosure controls and procedures. So you still have your control environment of those disclosures to kind of worry about. I think the one, for me, really positive thing about those disclosures is that they were based on the TCFD framework. I see that, and here I'm thinking a lot of multinationals, companies doing business in other countries, because by using TCFD to the extent they did, the SEC has really given us a good chance of getting good alignment with what's happening kind of internationally. So I think all of that is kind of very positive. I think the one question that comes up a lot is the extent to which this might drive behavioral change on your business kind of strategy and what you are doing, or is it simply just disclosure? I actually think this remains to be seen, but I'm certainly struck by some of the proposals. For example, your scenario analysis, transition plans, you only disclose them if you use them or have them. So if you don't, the proposal will not force you to. But on the other hand, all your investors and those looking in are going to see that you have no disclosure, therefore you do not have it. And so I think we may start to see kind of the pressure come from the investor side. On the other hand, I've heard some companies thinking, well, maybe this is not a great time to have a transition plan. Let's wait and see, because if I have one, then I will kind of trigger these disclosures. So I think there we will see some behavioral, potentially we have to watch and see if there are any behavioral changes. I think Mark as well talked about the governance and board expertise. So coming back to what Mark was saying, once again, the proposal does not force you to have it, but it wants to know what you are doing. And so that in itself as well creates the pressure to kind of up the ante on what kind of expertise you do have at board level. So it remains to be seen. But bottom line, I'm personally positive really that it's based on TCFD.
Excellent. That's a great punchline. Anthony, I'm going to combine these questions because I do want to get into what everybody I think on this call is interested in, is what can we be doing in advance of this rule, but maybe share your thoughts around the framework that companies are using around GHG disclosures, and then what are the challenges that companies may face around these SK requirements, and particularly around the GHG emissions?
Sure thing. Well, we've beat up TCFD to death, and it is the preeminent, climate-related disclosure framework, and I think it's relevant because of its, risk approach. Also considers, the usefulness for insurers and asset managers and even the lenders. So I think that's all been said. We see the GHG protocol, greenhouse gas protocol, being used a lot. What we like about it, it does have sector guidance, which is very important for the clients that we work with. No different than every service solution set we have across all our different firms. Our clients want us to bring an industry focus to that. So just like SASB has an industry framework, so does the GHG protocol, which I think is very helpful. What we also like about that one is there's some tools that the website has that you can draw from to enable better reporting, as well as certain learning modules that groups that are lacking that sophistication can draw from. So I think that's really neat. The other one worth mentioning is the Science-Based Targets Initiative, and this one is similarly focused on climate action, but more so in the way in which how we make reduction targets. So TCFD being more of a reporting thing today is useful in the way of driving these climate changes, but I think SBTI is a lot more deliberate around reduction targets and focused on impact, which I personally like for that reason. So those are just a little bit about the various ones that we're seeing. But overall, if I were to define the challenge that companies having, one is the skills gap, assessing who they have in their back office to do this. Do they have the requisite skills, and they need to go from the outside? But then next, around data aggregation. So we see companies ranging from data sophistication all the way through data incompetency because of having disparate systems. So you might be a real estate operator with multi-locations and global, and the way in which you process information from one portal to another could be challenging. And you might, experience that already with basic financial reporting, let alone your ability to quantify GHG emissions. So those generally are, the two big ones, and the remediation that way, of course, is seeking help, upskilling, and then on the data side is to streamline those reporting activities by way of technology. So we very much see technology as the enabler of better climate strategies for mid-cap companies. But the reality is there's so many different platforms and tools in the market that has just added to a whole other dimension of confusion for our clients that sometimes offset some of the good progress that I think we're making societally.
Great. Well, that's really helpful. Maybe we'll close out this section with a question for you, Mark. Anthony earlier alluded to some of the expectations by the SEC around attestation, but can you just say a little more about what the proposed rule says around frameworks and standards that could be used, and what are the benefits of requiring attestation? Why is this something that the SEC is suggesting should be done?
Sure, and let me start with a reminder on scope. So when we're talking about attestation in this context, we're talking about attestation on level or scope 1 and scope 2 greenhouse gas emissions disclosures. And those are only required for large accelerated and accelerated filers. I mentioned earlier, it'll be phased in from limited assurance, but wanted to put a boundary around exactly what we're talking about. So when you think about the attestation itself, you need a set of standards to do an attestation. And there are some minimum requirements in the proposed rule. So there's no requirement to use a specific set of attestation standards, but there are minimum requirements. And those minimum requirements are that whatever attestation standards are used, they have to be publicly available at no cost. And they have to be published by a standard setting body that has followed due process procedures, which would include things like broad distribution of the framework for public comment. There are some minimum requirements for the provider. I think one question that often arises is, well, do I have to have my financial statement auditor do my greenhouse gas emissions attestation, or can I use somebody else? And vice versa, if I'm using someone else today to do some greenhouse gas emissions work, do I, can I switch to my financial statement auditor? Because there's some scalability there. The financial statement auditor understands my financial statements, so should I switch to them? And the answer is either one. So there's no requirement to use your financial statement auditor to do greenhouse gas emissions attestation, but you can. There's no requirement to use someone other than your financial statement auditor, but you could use your financial statement auditor. So I think that's an important aspect of the provider. The minimum requirement for the provider include things like independence. So you must be independent from the person you're giving the attestation report to. And you also have to be an expert in greenhouse gas emissions, which would be things like significant experience in attesting to greenhouse gas emissions. There's some minimum requirements for the report, as well as some additional disclosures that the registrant might have to make. But I think by and large, and this is coming directly from the SEC's proposal, in the SEC's view, the AICPA attestation standards, the PCAOB attestation standards, and the IAASB attestation standards today meet their minimum requirements because they're subject to due process and they're all publicly available at no cost. Although they did raise the question in the proposal about, are there other attestation standards out there today or that are under development that might meet those minimum standards? Now, just a couple of minutes on benefits of requiring attestation. It all goes back to the SEC's mission. So protection of investors, capital formation, maintaining fair, orderly, and efficient markets. We've heard time and again, investors want high quality information, high quality decision useful information, and they believe that assurance provides that higher quality data in relation to data that doesn't have assurance over it. I think there's a couple of other academic studies that you could cite around capital formation. There's some evidence to suggest that assurance on corporate social responsibility reports lowers the cost of capital for entities that choose to get that assurance. And then from a fair, orderly, and efficient markets perspective, there's some evidence to suggest that rating agencies that use ESG information are able to provide more accurate measures and ratings when that information has been attested to.
Great, thank you. That was exceptional. I think this allows us to get into the meat of the moving forward. If the rule goes in the manner it currently is, and I did hear some hypothesis throughout the commentary, which I appreciate, but maybe we'll start with you, Julie, and we'll hit everybody on the panel. As we think about preparation, and maybe here we'll start with issuers, preparers, what difficulties could companies face as they prepare for the SEC upcoming final rule, particularly if we move forward with the timeline laid out in the proposal? So Julie, why don't you start and then we'll go around the horn.
Yeah, I really think, like personally, I cannot see it coming into effect anything like the kind of illustrative example that was in the proposal. I think it's just not viable at all, really, for it to be effective, and suddenly kind of the next day you're prepared. I think we saw it in like many of the comment letters from preparers, just talking about the time they would need to actually get ready, to get their control environments ready, not just the financial statements, but also for all of this information that would be filed. So I think that like Mark talked about earlier, about all of those challenges, all the things they'd had to put in place. And I'd like to think that the SEC is, I guess they're looking very seriously at that and the time that would take. At the same time, of course, if we're looking at Europe, we're seeing that timeline also around the challenges, we're seeing that being pushed out as well, which I think is just really the realism behind the fact of how long this will take you to prepare yourself for these disclosures. The other thing to mention that we haven't really talked about, of course, it's not just doing these disclosures, it's doing them on the same timeline as your financial statements. So I know certainly that I'm talking to companies and they say, well, we really regard ourselves at pretty much at the top of our game. We're doing all these disclosures, but if we have to then do them along the same timeline as the financial statements, we're going to need another 1 or 2 years to prepare, to get ready for that.
Well, it's a great point. You know, we're going to talk in a moment about the role of the auditor and how auditors could prepare. And I know one of the questions that came in was, you know, who does this? There's clearly a lot of benefit from having the same collective group of management as well as the same collective group of auditors touching the financial and the climate related disclosures, because there is so much intersection between the two. But how do you do that on top of each other? How do you leverage expertise as well as at the same time leverage commonality? I think it's a really great point. Anthony, what else do you want to talk about relative to challenges issuers, preparers will be thinking about or be dealt with?
Yeah, I mean, my personal feeling on all this is, like, we heard today talk about climate, but climate is just, you know, the material component of the broader ESG strategy. And what we're seeing across all global markets is ESG has become a forefront, you know, board level topic. I put it up there with, you know, digital and tech transformation. I put it up there with, you know, regulatory affairs, future of work, all those kinds of things. So, yeah, we're here today talking about climate, but I think it's important also to consider, like, the broader ESG strategy, how this fits into the organization's overall strategy. They're not two separate things that should live on their own, but instead they should be married together, you know, to evoke the level of, you know, societal and climate change that we're all seeking in this world. So in that way, I look at it as, you know, one, you need executive sponsorship, because in order for strategies to be executed as designed, you need those, you know, people of influence within the organization to help drive that level of change. We beat to death the topic of skills gap. So that's a big challenge which our clients are going through. You know, although there's this pressure to prepare now, let us not forget also, this is more likely going to be a multi-year process. So don't boil the ocean in terms of, you know, doing all the things you think you need to do, but you're not quite ready. We see a lot of issues around data quality. So consider some of the, you know, financial reporting controls that surround that process and try to emulate them in this way, but also to ensure that, you know, when you're considering climate and broader ESG strategy, to me, this has to be a cross-functional exercise across an organization. It has to have, you know, elements of risk and legal and finance and accounting and maybe even other disciplines. But one of the mistakes we oftentimes see is these things tend to live in a department without taking a cross-functional lens, and then all worlds don't get in sync, and it hinders the ability to report in a positive way. So those are just a few things that we're observing in practice here at RSM.
Okay, that's great. And that was pretty comprehensive. Mark, anything else you want to add relative to, you know, challenges issuers may have or put a pin into?
Yeah, I think putting a pin into time constraints is especially important. Julie, you hit on it. Anthony, you hit on it. But all of these things take time. Even starting at the top, getting effective governance in place takes time from a readiness perspective. There's the educational component. when I talked earlier about what does the S&P 500 landscape look like, not everybody is disclosing all of the things that the SEC's rule proposal puts forth. And I would wager, if I had to guess, that many of them are reporting a significant minority of the things that the SEC's rule proposal puts forth. And so therefore there is a large hill to climb in terms of knowledge and expertise. Maybe just a couple of minor but interesting points. I mentioned scope 3 earlier, and how scope 3 emissions are required when material or included in a target. How do you determine materiality for scope 3 emissions? I think is a debate that everyone's been having over time, and I don't think we've really reached a conclusion on that. And materiality being more of an art than a science sometimes, I think that's something that you want to spend quite a bit of time doing, because of the challenges of creating scope 3 disclosures. You don't want to figure out at the last minute that scope 3 is material. And then just more broadly with respect to greenhouse gas emissions, if I think about the conversations I've had with clients, that's probably the place where people are going to be the most challenged, because that really has the most deep expertise and deep understanding that might be required in order to comply with the rule proposal.
Maybe I think between the three of you, incredibly comprehensive and thoughtful around issuer, things to be thinking about, how to address risk, how to prepare. Let's put ourselves into the role of the auditors, those that are providing the services to clients. If this rule goes forward, again, assuming timing, types of assurance, what should auditors be doing in preparation? And Mark, I'll come right back to you on that to get started.
Yeah, so if I were going to give one piece of advice to an auditor, I think you need to get familiar with the rules and what they require. It's very easy to give a 3-minute, well, I say very easy. It was challenging to give a 3-minute summary of what the rule says, because it's 500 pages. However, there is a lot of detail in that rule that, unless you read the details, you might not clue into the fact that these are the types of disclosures that might be required. So let me give a piece of practical advice. The crux of the rule, it's a 500-page rule. There's 130 pages of cost-benefit analysis. There's, trying to do the math in my head, about 320 pages of narrative and background and overview. And then the last 50 pages is the statutory rule text. And that's where the crux of the rule is. If you read that in detail, line item by line item, now it's pretty dense from a rule text perspective, but that's how you're going to be able to digest the details of the rules. And every time you read it, it's kind of like reading your favorite book over and over again. You find something new and a little nugget of fun that you didn't find the first time around. So that's my advice.
All right, well, that's great, Mark. Julie, anything else on preparedness by the auditors?
I think then, if Mark's covered the rule, basically the attestation standards themselves. So I think they are used much less extensively than the auditing standards, right? So there's going to be this process of it's not just really the standards, it's the standards as they would apply to the final rule, and kind of understanding what the implications are, what the criteria are you're kind of attesting to, etc. And also Mark talked about different frameworks being allowed under the proposal. So it's also as well kind of understanding that if we look at the two main frameworks, the US and international, what are the differences between those in the attestation and how you would do it and the requirements.
And Anthony, that makes a ton of sense. Anything else from you on, what auditors should be thinking about to prepare?
Yeah, I mean, in my mind, if the audit profession is supposed to instill a level of public trust, I mean, they better, get credentialized. So for those in any of the large firms that have not yet, I think there's some, simple and easy ways to do so. You have obviously the TCFD licensure, which I referenced earlier. It's free, it's online. That's just one of the many. A broader view of ESG principles coupled with, climate direction is also included in SASB. Foundations of Sustainable Accounting licensure. So that's Sustainable Accounting Standards Board's FSA. And there's 2 designations that an auditor can obtain that way. A lot of professionals on our team have those. Global Reporting Initiative also has a licensure. And then if you want to spare yourself of those designations, there's other executive ed programs that groups like MIT or Harvard, NYU all do that are thought to be market leading. So as a profession, I'm observing a lot of the large firms are deploying that level of curriculum to their professionals, whether it's a pay-to-play thing where they're getting one of these larger universities to assist them that way.
I'm going to take over. I think we actually did what we set out to do as a collective group. I want to thank the panelists. We have comprehensively taken you through, I hope, an understanding of the proposed rules, what's happening outside the U.S., some of the challenges. I think we spent a good amount of time on that, as well as some preparedness. So hopefully this has been incredibly insightful. It has for me. And I want to thank you all for your time and attention.